slipped into the red. So nothing on the indices. 24,360 on the Nifty. The Nifty bank is at about 54,950. Absolutely flat here. The mid cap index is down about 0.25%, 150 points, and I think you've got the small cap index which will come up, which is also starting lower. That's about 40 points down, 0.25%, 17,385. But absolutely kind of sort of holding on to very, very flat levels as we begin this particular session. Almost evenly balanced, right in the middle. The number of stocks which are higher and lower on the Nifty. So you've got 25, right? I mean, ICICI on one end and Grasim on the other end. So let's get down to individual names, mid and small caps, etc. as well, because the index is not doing very much. It's kind of blinking red and green. Surabhi.
You know what? Before I talk about index stocks, Prashant, I want to pull up PG Electroplast once again. 22% on Friday, another 10% this morning. Let's pull up the stock. Okay, it opened up almost 9-10% down, now 6-7% lower. And I was just checking the shareholding pattern, how it stood after the promoter sold stake in May. So from a level of 49.4%, which is where they were at the end of the March quarter, June quarter shareholding, it's come down to 43.7%. The share sale happened in May at a time when the business was obviously going through difficulties. And I think it's more a question of just trust and credibility. And let's see, the management has been speaking on investor calls. We'll talk to them as well. And let's see what explanation they have. Business weakness is one thing, but disclosure obviously very, very important for the market. Anyway, coming back to the Nifty names now. On the Nifty, some green, Grasim, SBI itself, good commentary from SBI, 1% higher over there. There's some buying on Trent this morning. Adani Enterprises, NTPC. Some of the metals are doing pretty okay. Hindalco, Tata Steel, JSW Steel. Some hope building up, of course, around this US and China trade conversation that's going to happen today. Tata Motors is actually reacting positively. I mean, maybe you can argue a lot of the negative is in the price. Stock's been slammed over the last 1 year anyway. So is recovery in sight. Let's see, 1% higher on that note. On the flip side, ICICI Bank, the market is not too enthused. And I think the market probably is seeing merit in the argument that the analyst from Aquarius was just making, that in the near term, are you sort of, or in the medium term at least, are you going to be weakening your CASA franchise? That's the concern. 1% lower on ICICI Bank. Other weak names include Asian Paints, HUL, slight weakness there. Reliance is kind of dragging its feet, sluggish this morning. 0.5% cut. But net, it's even, Stephen, for the Nifty. Absolutely neutral, 9 points up.
The stock of the last 1 week has to be NSDL. It's 1,400 rupees now, 1,350 odd. I think let's pull up NSDL. That's the big mover from the listing price. It just moved one way. The float could be rather limited. Last few trading sessions, it's been moving very, very well. NSDL is listed on the BSE. That should come up for you on the screen. For those that got it in the IPO, well, they're very, very happy. And those that bought in the pre-IPO as well, now they would be breaking even. They'll be making some money because now the price is at around 1,400 rupees. So there'll be restrictions on selling these stocks because it'll be locked in. What else is doing well? Yatra, massive move out there. That stock is up close to 10%. So big up move is what we're seeing on Yatra. A couple of other good earnings reactions that we are seeing. It's actually up now 12%. Genus Power, that stock is up close to 3%. Massive volumes is what we're seeing on that particular counter. And keep in mind the run rate that they're going at, they could probably, outbeat what they've set out for this year itself. So that's why the street likes it. Volumes high, up close to around 2%. HPL Engineering, that's the other stock that's up. Uniparts, that's another one that's coming on the list in terms of big gainers. And I think you have Jyoti Structures as well, that's up close to around 5%. These are all big volume movers in this morning's trading session. So we should get some of them up for you on the screen. On the flip side, PG Electroplast, now it's down close to 10%. Best Agro, got hit last week. It's got hit even more this week. That, in fact, is down close to around 6%, I think, the last time I checked. And Concord Biotech, that as well, is getting a drubbing this morning. That's down close to around 5% or thereabouts. So big movers on the broader markets.
Absolutely. On the AC stocks, I just want to mention that Voltas also has had a complete washout quarter. Every number is a miss. So that stock anyway is down 6.5%. And this whole nervousness around the space has drawn down Blue Star. Blue Star numbers are already out. Everything's done, discussed. But again, just the sentiment negative is rubbing off on Blue Star as well, which is down about 2.5%. Prashant.
Absolutely. And, we got, 30 points higher on the Nifty now, 24,400 on the index at this stage. And I think you've got the Nifty Bank, which is also starting with about a 90-odd point higher start. That's about 0.17%. So this is a much better kind of sort of screen as compared to what the GIFT Nifty or the pre-open, etc., were indicating. Just a few other names here, right? I mean, of course, PG and Voltas. Amber is the other one, right? Amber is, again, big in ACs. 4% lower on Amber, so 7,045 on Amber. You got Siemens, which is down 3%. Vamakshi was talking about this earlier. Sagility is another one, 3%. Numbers were very, very strong for Sagility for the quarter, but stock's been at that 45, 44 rupee levels for a while. It's not corrected, though, in this market fall. Biocon is down about 3%. Wockhardt is coming off with about a 2.5% knock this morning. Concord Bio is down 6%, 1,500 rupees on Concord Biotech. Havells, I think we mentioned Havells is down 2%. Again, that same sort of, AC story there playing out. Deepak Fertilizer is down 2%. And then I can go down the list, but volumes start to thin out very, very quickly at this stage. HBL, engine is the largest volume-led gainer coming through this morning. It's up 10% on the back of solid numbers. Look at that, 2.5 million shares. Number one across the board on the NSE with regards to volume and price action. Sarda Energy is up about 6% as well. Again, it's got, for this point in the day, it's got large volumes. So 567 on Sarda. I think Nigel already mentioned Yatra.
Yeah.
There is Afcons, which is up about 3%. Yatharth is up about 2.5%, 3% as well. So that's the sort of picture as things stand right now. 45 points on the Nifty, 24,400 is where we are at. Mihir Vora is now with us, Chief Investment Officer at Trust Mutual Fund. Mihir, good morning. Great to have you with us on the program. Thanks very much for your time. I just want to, I know you don't want to talk about individual names, and I won't ask you to comment, but I want to ask you sort of comment on you to comment on a situation. PG Electroplast, sure, and of course, I mean, consequently, I mean, the PG as a episode. What would you kind of sort of make as a veteran investor? How would you read it? There is the angle of the fundraise, and we, by the way, speaking with the management in about 10 minutes' time. So that one, and second, of course, implications for the AC space, Mayor, if you want to weigh in. Stocks are weaker.
Sure, Prashant. See, the point is that there have been indications of an overall urban consumption slowdown. And you on your channel also have been highlighting, the white goods space, especially AC, fridge, etc., have not been doing well. So there were lead indications that this space is not doing well, and obviously companies which cater to this segment would be impacted. We are also there are some reports of some issues about the Chinese stopping or at least delaying permissions for engineers to come in and set up the compressor units, etc. So overall, the news flow has not been that positive, and I don't think it's too much of a surprise that this segment and suppliers in this segment have shown signs of margin pressures and slowdown.
But on this issue, I mean, outside of the business point, Mihir, hi, morning. Surbhi here. My bigger question is, and I invite everybody to go and check out Hormoz's article on this on our website, CNBC-TV18.com. He's written how mutual funds, because obviously the business was so good, the commentary was good, how mutual funds and retail investors have loaded up on PG Electroplast in the last many, many quarters at a time when the promoters have sold, and the promoters clearly haven't, disclosed this timely enough, perhaps, this whole business environment. So, Mihir, will this cast a shadow? Or do you think the market will move on and PG will go back to its winning ways? Because it's good business, then running into slightly tough weather, versus the fact that perhaps there was not adequate and timely disclosure. Your thoughts on how the market perceives such events, not only in PG, but in general?
Yes. So overall, I think the manufacturing space, especially the durables and electronics manufacturing space, including mobile phones, etc., it is a sector which has high potential, high growth potential, but which also needs a lot of capital investment. So you have seen a lot of companies in this space come up with fundraisers because they have large plans. Some of them have plans in adjacencies. Some of them have actually gone into semiconductors and the PCB manufacturing space also. So this is a very exciting sector from the growth potential point of view, but it is a sector which requires capital. So, issuances and QIPs and capital raise is not a surprise, because when the going is good, when the markets are in a bullish phase, investors are looking at growth stories, and this space does offer long-term growth potential. So I'm not too surprised about the fundraise part. As far as disclosures, etc. are concerned, probably the timing can be better in some of these cases.
All right. Hi, Mir. Good morning. Good to see you in. But how are you feeling about the markets on the whole, Mir? This Trump tariff tantrum, that's something that's definitely weighing on sentiment. But I think the bigger cue is what's going on the domestic front. And the first quarter was actually very, very weak. If you look at power demand, if you look at, aviation, traffic over there, if you look at movement of steel and cement via rail as well. Now, all these indicators actually, at least in the last 7 to 10 days, they're showing some signs of life. If I look at the FASTag data, in value terms, the growth is good. There'll be an element of price increases. If I look at the power demand, that actually has perked up a little bit. Steel and cement, the movement via rail, that as well has done quite well. Are you seeing signs that things are going to be recovering? Because I'll tell you what, the next 45 days are going to be very, very crucial from a market perspective. We'll have pre-Diwali buying as well. Do you think you're seeing signs of a recovery domestically?
I think right now it's more of a hope case in the sense that by default, we do consider this period as a slow period. So slowness in some of the segments that you mentioned is not a surprise in this particular time of the year. But always the hope is that once the monsoons are past us and the harvest comes through, domestic consumption and demand will come through. That's always the case that we work with. And given the fact that monsoons have been good, liquidity has been provided by the government and the RBI, there is a reason to believe that the natural cyclical recovery in consumption should happen in the busy season, in the festive season, so to say. So I don't think that's an irrational assumption to make. We are also going with that assumption. Having said that, the bigger elephant in the room is how the trade talks are going to pan out, because India is clearly at a disadvantage as far as the tariffs are concerned versus a lot of its potential labor-intensive manufacturing competitors like Vietnam, Cambodia, Thailand, and China, of course. So this 50% tariff is definitely not sustainable, and we hope that before the deadline of August is concerned, we should be able to come through some sort of an agreement, because clearly 50% is not tenable. It would destroy a lot of exports to the US. So, and that, of course, can lead to job losses, and that can impact consumption more than the cyclical recovery.
All right, Amir, thanks very much for that. Good getting those details from you. Really appreciate your time here on CNBC TV18. I think we can go across to the management of PG Electroplast now. The stock is down about 10% once again after falling over 20% on Friday. Shocking guidance cut coming in from the management. We have Vikas Gupta, Managing Director at PG Electroplast, who's with us. Vikas, good morning. Great to have you with us here on the program. Thank you for joining us. You've got, I'm sure, lots of questions around what has happened, what has transpired. Let's just start with what happened, Vikas, because the guidance cut from you came as a large shock to the market, as you can well imagine, because even at the end of the last quarter, not this quarter, the previous quarter, there was enough and plenty indication that the AC season is going to be weak. We heard it from OEMs that we speak with. We heard it from others as well, that generally things are looking a little weakish. The season is not going to be all that great. But we've heard it from you after the quarter has ended. So let's just start there. What happened?
So, good morning, Prashant. It's always a pleasure to be on your show. So basically, I'll try to first answer the question on the quarter one head on. That is a more important thing, that how it played out. So, everybody was expecting that the overall AC sales will rebound in months of June and July. In fact, we were operating at more than full capacity in months of April and May. And so it was looking very, very, very like the momentum was going in our favor. But actually, as the channel inventory built up, and there was no rebound in the sales for the air conditioners, the secondary sales of the air conditioners in the months of July and August, as we are seeing now. So we had to revise our guidance accordingly.
But
So
Mr. Gupta, sir, if you allow me to ask you this, and you've been in the business for so long, right? And you'd know this, and I know it's more, you're in B2B sales, but in general, the peak months where the best offtake for ACs happens is actually much earlier. I mean, February, March, that's where people start buying to build up for the summer months. In fact, if anything, June and July usually, I mean, it's not the peak season, isn't that so? So how is it that you didn't see this building? Because from fan makers to cooler makers to AC makers, Blue Star, Crompton, everybody was telling us that it's a weak summer and expect a sluggish Q1. So how did you not see it?
So, Surbi, let me clarify on that. If you look at the peak months for the production for a company like ours, start in fact in month of November, December. So we start ramping our productions in month of November, December, and the sales and the brands also start picking up the inventory from our factories. And the channel partners also start picking up the inventory, and that's the primary sales which start happening in months of January, February, March. So there is a lot of anticipation in the channel, in the industry, that the sales will be good. So that's why everybody built up the inventory for that. So as we progressed in the month of May also, we were hoping that the market will improve, the demand will improve. We were having the order book, we were having the forecast from our brands, our customers, that was quite robust, and we were building on it, and we were believing that numbers, and we were going ahead with those production numbers. So it was only later in the month of June that we saw that the secondary sales are not picking up and the channel inventory is becoming huge. And that's when the demand from the brands fell off the cliff for us. And we realized that we are sitting on a huge inventory for us.
Got it. So I'll tell you what, I think what has compounded the problem, I'm sure there was some, misreading of the situation. Very clearly that's happened. But what's compounded the problem from a stock market and your investor perspective is that all of this has happened when you as promoters have sold stake in the market. And that has a business hit is one thing, and business hits always happen. I mean, it's a cyclical business. So just explain this to us, and I'm repeating for the benefit of viewers. March 25, promoter shareholding 49.37% as on the Bombay Stock Exchange. End of June quarter, promoter shareholding 43.72%. So when people tie this together, they're saying, what is this? Why won't we give in an advance warning? So many companies do business updates. You could have given an advance early indication. Could you not have done that? Was that a miss?
So, Survi, like the optics and the timing looks like that, and it is unfortunate that it is looking like that. Please understand, as I told you earlier, the May month also we were operating at more than our capacity. The sales were looking good, and the block deal that the promoters have done does not change our outlook on the business. The long-term outlook on the business remains intact. And we have done the QIP also. We have raised 1,500 crores from the investors, from the marquee set of investors in December 2024. So we are already working on those capex guidelines that we have given earlier. We are building on our new product diversification. We are working the new launch of product platforms. We are building up new capacities. So the long-term story of the business remains intact. It cannot be impacted by the one single week summer.
All right. Hi, Mr. Gupta. Good morning. Thanks a lot for joining in. Mr. Gupta, you have created big wealth for investors over the last 5 years. The problem is what has just happened. So let's get a couple of those questions out of the way. You have guided for a net profit of around 310 crores for this fiscal. Is there a downside risk to that number?
So, Nigel, as of now, we do not see any downside risk to that number. So definitely the margins are getting impacted. We know that. But as of now, we do not see any downward risk to that.
Because even after this correction, you're still at 15,000 crores of market cap, which doesn't make the stock very cheap. So that's why investors will be fretting if in case that 310 crores of net profit guidance will be missed. You're saying no as of now, right?
So, Nigel, if you've seen the history of the company, we have been always trying to outperform the guidance.
Correct.
So we will try to do that.
The problem, sir, is you're best remembered for your last performance, and the last performance has been a little bit jittery. So hopefully you find your form yet again. So that question out of the way. Next, your promoter holding from around 65% because of dilution, the QIP, because of the block deal, it's come down to 43%. Now, I'll tell you what, analysts will say this and that, buy and sell side will say this and that, but the promoter is the best analyst on a stock. And if he's going to back up the stock, then it's going to be important. Since this sort of an untoward event has happened, would you consider coming in there, buying 1%, 1.5%, giving some confidence to the shareholders. Because currently, all those marquee names, they are fretting a little bit. They're saying Mr. Gupta was promising us big growth, and that's not really taken place. Would that be an option?
So, Nigel, like as per the block deal, I think terms, we are not allowed to do any trade for a period of 6 months. So, given an opportunity, we will definitely like to participate in that.
Exactly. So that's my next point then. 6 months down the line from that May 26th, when you sold that block, will the promoter entity, try to come in there, increase their stake? Because as of now, there's no visibility. Q1 has been an absolute howler. You've gone ahead and cut your guidance. Next 2 months will be plagued by discounts and heavy inventory in the system. So probably, the intent could be post this cooling off period, Mr. Gupta and family could come in there and increase stake.
So, Nigel, we will definitely participate if the time and the rules permit. We will like to look at that opportunity also. But
where would you want your stake to be, sir? Sir, it's just a question of confidence. Like Nigel said, your stake has come down from the 60s to now 43, 44%. When this window is, whenever the window opens, where do you want your stake to be in your company? How much equity do you want to own, sir?
So, Surabhi, I don't feel that we are sitting at a small stake in the company as a promoter family. Sure, if you look at our peer group, so we are sitting very decently at the kind of stake that we have in our company. And as I told you, that we are fully committed to this business.
Right, Vikas, got that. Yeah. So it's not, no, absolutely. It's the incremental change which was the promoters sold. That was the point. When you met investors in May for this for the promoter stake sale, you're saying there was no indication at all of the fact that this is, and all this happened in the month of June. That's what you're saying.
So I told you, Prashant, like what happened. We were already running full steam in month of April and May and June as well.
Okay.
So we were hoping that the recovery of the demand will happen. It didn't happen that way.
Okay. Now, Vikas, how by this inventory that you're sitting in, by when will this return to normalized inventory?
So for us, the normalized level of inventory is almost a 1 month production. So we feel that by the month of October or November, we should be normalizing the inventory levels to a level of 1 month production. So we already have some kind of indication from the customers for the coming season, and we are working with them to see how to recover the situation.
October, November is when inventory gets back to the standard normal 1 month sort of inventory, right? Inventory level.
Yes.
So 2 quarters. I mean, you've got to basically bear for 2 quarters in that sense. That's the way to look at it from here. Now, could you give us a sense of margins as well? 125 to 150 basis point cut in margin guidance. What levers do you have? Where do you see margins basically from here on? And what levers can you use to restore margins to F525 levels? Vikas.
So please understand, currently the margins have been impacted. There are broadly 3 factors that have impacted the margins. First is the finance cost. With the kind of inventory that was there in the system, the whole working capital was tied up, and that we had to use a lot of discounting and factoring to manage our cash flow. Secondly, please understand the AC season is a highly seasonal. The profitability is highly seasonal. We usually make our money in the peak months. Then we have to manage our fixed costs during the lean months. But in the current year, as the summer season shortened and the sales fell off, so the number of lean months have gone up. So we have to manage our cost on that, and that has an impact on the margins.
Sure.
So that is where the operating leverage actually turns against us in that case. So we are trying to see how to recover from that situation. Thirdly, the input costs have also gone up. The dollar exchange rate and the copper tubing, everything had an impact on the margins as well.
Sure. Sir, I just want to go back to that point. I think that'll be very, very reassuring for your investors to know. You said that you're committed to the business. I ask that question again, sir. What is the level of equity shareholding that the promoter family wants to maintain, even when the regulatory window opens up again? You're right now at just under 44%.
So, Surbi, if you look at the when we did our QIP of 1,500 crores, our shareholding went below 50%. So, in our case, in our family, there was a lot of discussion on that whether we should lower our stake in the company below 50% or not. But we have to see what is the good for the company and how we can grow our company. Even if that required for us to dilute our stake below 50%, we went ahead and did that. And we felt that was a better thing to do for the company in the long run. So the equity holding of the promoters is, I think, 43% or 45% or 47% does not make any difference. It is that the commitment of the promoter family towards the business is more important.
No, absolutely, sir. I mean, your point is well taken. There are completely professional companies with very low promoter holding, and the IT sector is an example of that. But investors do take that as some indicator of what's coming. If the promoter is lowering the holding, who are the bigger institutional investors? Therefore, I ask that question. Will you maintain it at least 44%? Could it go down? Would you want to go up towards the 50 mark? What is the intent of the promoter family right now?
So, Surbi, the intent of the promoter family is clearly to look at how to grow the business. We will be engaging with our long-term investors. We will be meeting them in coming days and try to reassure them how the business is going to play out in coming months and coming years. That is more important. 1 week summer cannot define the destiny of the company.
All right. Mr. Gupta, so growth is what you're focusing on. And since you told us, that we could look at some of the peer companies as well. Amber is one peer that has 40% of promoter holding. But the last quarter, their growth was phenomenal, in terms of year-on-year growth. But it appears the industry itself went through a bit of a weak phase. That said, what about the compressor? That facility is what we have been looking forward to. That's deadline has got pushed actually numerous times. And we have chatted in better times as well on this channel itself. Tell us, what is the date? Which quarter onwards do you expect things to start moving ahead?
So, Nigel, for the compressor thing, we do acknowledge that it has been delayed, and it has been delayed quite a lot. But from our side, we have done our bit. We have constructed the building. We are ready with that. We have already evaluated all the RFQs for the equipment or the plant and machinery that we need to buy. We are just waiting for certain approvals. Our Chinese partner is waiting for certain approvals at their end. As soon as they come, we will be placing the orders for the equipment and everything. Definitely, the timelines have been pushed now again. So we are hoping to have certain kind of clarity from our partner in month of October.
Okay. So FY27 is the safer timeline, Vikas?
So FY27 definitely looks better.
Yeah, okay. For this compressor JV to kickstart in that sense. I just had two more questions. Are there, other AC-related stocks are also coming off sharply? I think you were mentioning that what you've seen in this summer in terms of AC sales is the worst since 2008, Vikas?
Yes, Prashant, yes.
Yeah, 2008 was the GFC. I mean, of course, there were other factors then at play as well. Has something really, is there any reason for demand to crater like this, as you see it?
So, please understand, Prashant, like if you look at the last year, when the demand went through the roof, so nobody could anticipate that time also, like how the market is going to behave, how market actually behaved. And there was the talk in the market that there was a shortage of the inventory in the channel, and there was a lost opportunity of more than 1 million or 2 million ACs which could have been sold because of the shortage of the inventory. So it is very difficult to anticipate, but please understand, there is a lot of impulsive buying of air conditioners still in India. And as there is a longer dry spells, the people tend to go and buy ACs. That is something that needs to maybe change over a period of time. But if you look at the long-term story, I say again, the long-term story for this business looks very robust. We should not try to define this business on the basis of single summer. So we have to look at that way.
All right, Mr. Gupta, very quickly before we let you go, will you consider buyback? I'm not sure about the regulations, but you can't buy from the open market. Since the stock has crashed in this manner, you have lowered your capex as well. Is a buyback something that you all could think about?
So no, so we will be like the current capex is already going ahead. So there is not a scope of buyback that we are looking at. We are going ahead, building our capabilities. We are not stopping here.
Yes, got it, Mr. Gupta. We appreciate you joining in, fielding all those questions. As you're saying, the longer term, you'll have your focus on the industry is going through a bit of a weak phase, but you're coaxing your investors to keep the faith. We'll hold you to these numbers, and we look forward to chatting up with you, sir. But for the past quarter, it's been very, very disappointing for your investor community. And as we speak, the stock is down close to 15%.
Okay, so that is PG Electroplast. Market still has more questions. Let's see. The management has given lots of answers. We'll see how this plays out earlier. But from all the secondary market action, let's talk about the primary market because there's a new issue out there. Bluestone Jewelry's IPO is opening up. It's an issue which is a little over 1,500 crores, 1,541 crore rupee IPO to be precise. It opens out for subscriptions today. The price band has been set at 492 to 517 rupees per share. The company has raised just under 700 crore rupees from anchor investors. So let's talk about the business and the prospects with Gaurav Singh Kushwaha, Chairman and Managing Director, and CEO Rumit Dugar, Chief Financial Officer at Bluestone Jewelry and Lifestyle. Gentlemen, thank you so much for joining in and good to have you with us. I can say, I've been a customer already. But so I have two straight questions. One on the losses, because while the company has been growing very, very well, you've exhibited 50% growth. It's, fashion jewelry, jewelry for the modern woman, etc. That's been the positioning. Losses have continued. That's one part. The other question that I had was actually on what happens to the IPO, because there's been some chatter and some conversation that apparently there is a case that's been filed in the Securities and Appellate Tribunal, making some allegations on disclosures, etc., things like that. Where does that stand? I mean, and could it impact the IPO? I don't know what's happening at SAT. So if you could just clarify.
Sure, let me take that. So on the SAT case, there was an appeal that was filed by one of the litigants. That appeal, there has been multiple hearings that have happened. The appeal has not even been admitted yet. And we've got all the requisite approvals. So absolutely there is no impact on the IPO.
And on the losses part?
Yeah, sure. So on the losses, look, I think the business has seen tremendous amount of growth. We've been investing quite aggressively in the business to build scale. As you can see, we have almost 275 stores. And we are at a point in time, if you look at our EBITDA margins are already close to 7%. And a lot of the capital investment has gone in the last 2 to 3 years. And thus, we are coming to a market at a time where a lot of the investments have gone. The growth is still very high. And thus, there is tremendous amount of operating leverage that is flowing in the business.
Morning, we're calling it KYC, Know Your Company. So Ruby knows the brand. For those who don't know the brand, Gaurav, if I can request you to just tell us a little bit about the business itself.
Sure. So we started as an online-only jewelry brand, and for 7 to 8 years, we were largely online only. I think at that time, we realized a very peculiar user behavior where people are finding it very comfortable being able to browse so many pieces of jewelry sitting at home. But I think given the nature of the category, given the price point, given gold, diamond, etc., there was a push from customers that, okay, we also want to see it in person, physically before completing the purchase. So while online was doing its job of pulling in people in droves, and see, online in a way is a much better, it's much better at letting people browse jewelry because that is something you cannot do in offline stores. And so essentially that worked very, very well for us. And the ask from users was to allow them to also see it physically before they could buy it. So we started opening stores and we are very young to it. So FY19 was when we opened our first store. We opened 5 stores in that year, then 11 and so on. So and we saw tremendous success, and that's why we started increasing the store presence exponentially. And that also links back to some of those questions about losses, because those early stores are extremely profitable. But what happens is, because it's only been 5 to 6 years since we started opening the stores, the ramp is like this. And most of the stores are sitting in a very, very young cohort. But they're all showing very strong SSSGs. So if you look at same-store sales growth at a blended level also, that's 30% plus, which is kind of unheard of.
How many stores do you have now?
275.
Across, in terms of...
Across 117 cities, across all geographies. In fact, another beautiful thing is in this category where most of the players are very zonal, very regional, we are among the two who are naturally national.
In terms of the split of products that you sell, how does that, gold and...
So almost 67% of our sale comes from studded jewelry, which is gold with diamond or gemstones. and 30 to 35% is from plain gold jewelry. And we also, as a consequence, we also have industry-leading margins. So our gross margins are to the tune of 37, 38%, which are, again, so our growth and margins both are unheard of in the industry. And I think those losses are a result of some of the front-loading of investments that we've done.
All right. Hi, gentlemen. Good to have you all in the studio. Looking forward to interacting with you all, on a quarterly basis, at least with regard to your results. And maybe since you'll be given that push, visit one of your stores as well. That said, where do you all turn profitable?
So, I mean, that'll be a forward-looking statement, obviously. So we are constrained by that. But what we can tell you is the business momentum, as Gaurav mentioned, is pretty strong. We've grown at about 50% CAGR for the last 3 years.
Okay.
A lot of the capital employed in the business has gone in. If you look at some of our older cohorts, they generate about 24% store-level EBITDA, which is something that's part of the disclosures. And there is no reason for us to believe, given the kind of growth momentum we are seeing, that there should be any difference in the younger cohorts.
All right. So you'll have cut out the path towards profitability is what you're telling us. And once you list, then I'll push you a little bit more on that point. Got that out of the way. But if you could help us out with, your margins as well. If I look at ad spends as a percentage of the sales mix, it's relatively higher in comparison to the industry peers as well. Where does this number settle at?
So, look, in terms of A&P leverage is pretty high, and it's a function of what is the size of the revenue base. So, if you look at some of the larger brick and mortar peers, the revenue bases are much higher. Thus, as a percentage of A&P, it keeps coming down. So, there is reasonable amount of operating leverage that is sitting on the corporate costs and A&P. We've seen those levels come down from about 12% 2 to 3 years ago to almost 9% last year. So we're seeing that continued trend of scale driving a lower A&P.
I just want to check on this number. A colleague was telling us that as of now, if we talk about total revenue, then online is giving about 15% of your total revenue as of now. Would that be right?
No, so, okay, the way we see our business is we don't see online and offline channels separately. So all our journeys, all our users start their journey online. Some of them are comfortable placing the order online also. But for most of those people, they actually are more comfortable once they have shortlisted online to walk into a store and then convert. And just to put it in context, this is like pretty much buying a car. You can do all your research online while buying a car, but you won't click a buy now button.
No, absolutely. That's philosophically, how you've seen the business.
In terms of invoicing.
But I'll tell you, sorry, go on.
In terms of invoicing, that number is lower than 15%.
Yeah, it's about 6 to 7%.
6 to 7% is actual purchase happening only online without the store walking.
That is invoicing online.
Invoicing online.
What also happens, Surbhi, is that if, let's say, because we are an omni-channel player, if you place an order online and that product is sitting at a store which is 2 kilometers away, it'll get delivered from a store.
So the reason
it'll reflect in store revenue.
The reason I'm asking you is very, very simple. If it was, if the bulk of it was happening purely online and there's no need for physical stores, obviously it's great for profitability and margins, right? That's not the case. I was a customer who came in who was a walk-in customer, didn't even bother checking online. So as your store count keeps increasing, and you'll do a blend of mix and match of both styles, what's an aspirational, and I'm not even asking FY26 or 27, I know you can't talk about that, but give us a directional aspiration. Where should EBITDA margins settle at once stores have matured, once the model has matured, say 3 years down the line?
So I think the best way to kind of look at it is how my older cohorts are performing. My older cohorts, which are at a 10 crore revenue productivity at a store level, deliver a store level EBITDA margin of 24%.
Okay.
Right? So that, and that happens at a 10 crore productivity, right? So unlike big box, we don't need a 40, 50, 60 crore store productivity to deliver a 23, 24% store level EBITDA. We do it at a much, much lower revenue threshold. And the reason for that is our gross margins are close to 38%. So directionally, that's the performance.
20% plus could be an achievable target a couple of years down the line, not immediately. Okay. Can't say much.
I can't say much.
I just have to ask the lab-grown diamond question. Is there a threat? Because that's
we don't see that playing out in the smaller diamond categories where we are our majority plays. So essentially, diamond category also, there are two type of customers. One is solitaire customer, other is people who buy designs that also happen to have diamonds. And those diamonds are very, very small diamonds. So typically what's happening is the lab-grown impact is being seen in the solitaire space, be it US, be it India and so on. And I think Titan also in their multiple commentaries has revealed almost the same thing. In case of smaller diamonds, there's hardly any cost advantage of lab grown, and hence there's hardly any momentum in that particular space.
So you're not looking to go big on
And solitaire is only 2 to 3% of Indian market, right? India is not a solitaire heavy market like many of the Western societies. India is more like design market. We have jhumkis, chandbalis, plenty and plenty more of.
So you're not looking to really push on the lab.
We are not.
All right, gentlemen, we'll leave it there for now. Thank you very much. And hope to speak with you on the day of listing. And of course, we'll have many more conversations after that. Good luck.
Thanks, Prashant.
Thank you.
Thanks.
Okay, I think we've got the market, which is, I mean, actually it's not moved, right? I mean, it's right there, 35 points, the Nifty 24,400. And although the overall market breadth with about 45 minutes of trade behind us is a little negative, 1,500 stocks are lower, and you've got about 1,050 stocks which are higher. We'll take a break, more coming up on the other side.
Welcome back. Let's keep it with the corporate conversations then. Cummins India reported a good set of numbers for the first quarter. There was a beat across the board and the stock was, of course, surging higher in Friday's trading action. Revenue growth was driven by healthy domestic and export sales. Our colleague Vamakshi caught up with the company's MD, Shweta Arya, to discuss the quarter gone by and the prospects for growth going ahead. Take a look.
The growth is very broad-based across different segments in the domestic market, across different markets from an export perspective. So very broad-based. So likely going forward, we should see this kind of demand coming in and our ability to execute better on that demand.
Just wanted to check in on your exports then. You mentioned they have not been, you've been cautiously optimistic on them as you've been highlighting. This time around, the exports were up almost 34%. So did you see any sort of pre-buying maybe that probably came in from the parent before, the tariffs came into force? Was that, number one, the reason behind the exports going up? And number two is, on one side, we do have some positives like the FTA with UK. On the other hand, we have 50% tariffs from the US. So how are you assessing the global situation right now? And, how are you navigating these sort of challenges?
It is definitely challenging times for us, as is for everyone else who has exports around the world. The good thing is that our exports are diversified to different countries. So as you rightly said, on one hand, there is tariffs from the US. On the other hand, there is FTA as well coming in. So our teams are evaluating how best to position ourselves. But the diversification of our market does give us a natural balancing factor. We are trying to see how best we can take advantage of the places which are in our favor to increase our presence in at least those markets and balance our exports thereby.
All right. let's also discuss how the pricing environment has been for you, right? So versus where you were in probably the beginning of the energy transition norms to now, have you been largely been able to hold on to the pricing? Is that correct?
We have been largely able to hold on. In different segments and different nodes, there have been movements in the whole year. Broadly, we have been able to hold on to pricing, although I will say that there are huge competitive pressures in the market. So we keep monitoring that situation. At the end of the day, we want to be very competitive in the market and provide the right value to our customer base.
Sure. So given the kind of competition that is now creeping in, across the nodes, would you perhaps look at revising your pricing in order to maintain your market share? Is that something that you might consider in case, the competition does go ahead and offers more competitively priced products, given that India, is a very price-sensitive market?
What we try to do is, one, we continuously try to optimize our own cost base, so that we get that leverage if we have to change our pricing in the market. And we also monitor the market to be competitive, as well as we work with our customers to help them understand what value we bring to the table when we sell the products to them. So it's a mix of all those three. It's not always that you have to only react to pricing. We have all these levers with us which we can work with. And the product has been very well accepted by the customers in the market.
All right. And, let's also talk about your margins, because at 21.45%, at the highest we've seen since Q4 of FY24. So if you can just help us understand what is driving this improvement, and, can you help us understand if you would be able to sustain at these margin levels, and are there any other levers that could perhaps play out that could probably push them even higher from here?
So from a margin perspective, if we look at this quarter, there's always a product mix that plays in different quarters. In this particular quarter, there is favorable product mix that has played out. And also because we had the volumes in this quarter, so there's some leverage benefit on our costs that we got. Going forward, if the volumes increase or stay closer to where we are, then we continue to get the leverage benefit. The levers in our hand are internal cost optimization, which across the board, we work on that, direct material cost or our own other expenses. We work on those. Those are the levers. And for sure, catering to the demand in the market and executing as well as we can, so that we get that volume benefit and the leverage that we have been enjoying in this last quarter.
Sure. And, you've mentioned about volume. So I believe last time around you had said that, volumes would probably cross the CBCP2, products in the next 1 or 2 quarters. So has that happened right now?
The volumes are actually back to the pre-CPCB4 plus era at this point in time. They haven't crossed. They are the market volumes. The market volumes are back to pre-CPCB4 plus numbers now.
And for you, is it better?
It's a different kind of a mix now, because there are different segments which are at play now versus the earlier time. So it won't be right to compare just the volumes of now versus pre-CPCB4 plus.
All right. And, you've also opened up a new opportunity for you with the BESS. So if you can just help us, quantify what is the kind of total addressable market cap that you're looking at over here, because I'm sure you must have thought about the opportunity and thereby launched this product. And other than that, what could its contribution be to your overall revenue pie, not in the short term, but at least in the medium or the long term, perhaps?
So we have launched the battery energy storage system, considering where the market could move. And also it is in line with our Destination Zero strategy, where we want to contribute towards products which can bring us towards utilizing different kinds of energy sources better. So this product is in line with that strategy. We are right now working with customers in India to see how they accept this product. There is a lot of value that we can provide to our customers. Largely, our customer base in the power generation segment would like to diversify the energy sources that they use. And battery energy storage system is that possibility that we can provide them. So from that perspective, we have launched the product. Yet to be seen what kind of market can we garner through this product launch.
So you're still assessing how customers are reacting to your products. But I mean, if you can just give us a ballpark of the kind of investments that you could perhaps make in this particular segment.
So as of now, we have launched a range of battery energy storage systems across kilowatt hours. We will see how the product gets accepted in the market and then decide how do we want to invest in terms of promoting this product more. So for the time being, we are testing the market with the product and seeing the acceptance.
How would this product fit in with your overall blended margin? So therefore, would it be better than the margins that generally, I'm not asking about your company specific margins, but in general, when it comes to the margins for BESS, are they better as compared to the power gen?
I would say that the power gen margins would be better because this is a new product. These are experimental days. And in the initial period of time when we seed these units, we will not, either the industry or us, the margin profile will not be same as power gen. Power gen would be higher.
All right. Well, that's the management of Cummins in conversation with my colleague, Vamakshi. Midesh is with us with what he'd want you to do. We got a bit of a lift today to 24,400 plus. Midesh, welcome back again. What would you do?
Yeah. We got a bounce back. The opening was slightly subdued, and then we got a mild bounce back. I think aided by the bank Nifty, and that's where the action is. Indian Bank is something which I would recommend on the buying side. It's breaking out of a supply pivot of around 655, 657. So keep a stop below that. 654 is what I recommend. Look for a target of around 690 on the upside. I think SBI is leading the chart, but Indian Bank is the one which is outperforming. And the other stock is Muthoot, which I would turn slightly negative upon. So sell the stop at about 2,605. Look for targets of around 2,500.
Okay. All right. So individual trades there. Mitesh, thanks very much for that. We'll take a break. Manisha on the other side, commodities in focus.
Welcome back. Equity markets are having a quiet morning. Let's find out what's the latest in the world of commodities. We have Manisha with us in the studios now. Manisha, what's captivating your imagination this Monday?
Well, the energy markets really, because that is where we've seen a lot of movement come in the previous week with a very, sharp decline that we've seen across energy board, whether it has been crude prices, natural gas, heating oil, almost everything. So for the crude oil prices, we've seen 5% of a decline in the previous week, and we've opened Asia 0.5% on a weaker note. That tells you that you're trading at a 2-month lows for the WTI and the Brent prices also. All eyes on the US and Russia presidents meeting in Alaska on 15th of August. As of now, the US is pushing for a ceasefire. It has been doing that for some time. While on the other side, Russia is demanding territorial concessions. Russia has been hit with 18 packages of sanctions from European Union and various sanctions from other countries, including US as well. So that's exactly what they're asking for. Well, at this point in time, there also is threat about secondary sanctions on buyers on crude oil. For example, India, China and Turkey. That is the reason these countries and most of the global markets really will be watching out for this event and the statements coming in from there as well. There also are concerns that the US tariff could slow down crude oil demand going forward. That seems to be weighing onto the markets as well. OPEC and Plus, while they have continued to increase production and until the month of September, but the latest numbers show that the OPEC and allies are pumping less than the newly increased output. On paper, it's 2.5 million barrels per day. But when you look at the last couple of months, the kind of increase that they should be doing is not happening. That perhaps could be supportive for the prices. The markets also have seen some support in sense of the China crude oil stocks. For the second quarter, we've seen 82 million barrels of an increase therein. So China clearly seems to be collecting inventory there. And then the Europe oil stocks are down 9% of the 5-year average. You also are looking at US stocks down 5-year of the average as per the seasonal markets there. So these are a couple of factors that actually could be giving some support to the markets. But at this point in time, as I said, all eyes on geopolitics and tariffs, and some easing of stress could be coming in from that. I also want to take you through on what natural gas prices seem to be doing. A big move coming in here. We've seen nearly 5% of a decline previous week. It's trading 3% down in the Asian markets right now. The production growth is much higher at around 6 billion cubic feet per day, while the demand growth at 3.3. The street also is looking at the kind of inventories that European markets are holding, and that is weighing on. Bank of America, interestingly, has cut natural gas price expectation to below $3 per MMBTU for the fourth quarter as well. And the last plate should show you on what we've done in sense of prices for crude and natural gas as well. So in the last month, we've seen crude decline by 5%, but natural gas was down 15%. And in this year until now, we are negative in the double digit for both of these commodities. But this is going to be a very interesting week. You have so much events, so much data, and so much statements anticipated as well. To begin with, you have the US inflation numbers coming in, CPI and PPI, both of these in this week. Second, 12th August is deadline for US and China tariff truce. Whether we get an extension on that is something that the street will watch out for. And then US and Russia presidents meeting in Alaska on 15th of August is going to be a very important event. And moving forward, it is going to be about the US Fed Reserve Jackson Hole Symposium. That's from 21st to 23 August. A lot of statements anticipated out of this as well. So promises to be a very interesting week ahead.
Okay, and if there is a peace deal on Friday, I think oil prices fall a little bit if it happens. Manisha, thank you very much for that. It's a special segment, Indianomics. Lata in conversation on the impact of the key Supreme Court decision on the power sector with former power secretaries Alok Kumar, Pradeep Kumar Pujari and Nikhil Nagani of Bernstein also weighing in as far as individual companies and stocks go. Coming up in just a bit.
Welcome to Indianomics. Today we put the spotlight on a very important Supreme Court order to the state electricity regulatory commissions to raise tariffs and allow discoms to run on commercial lines. Were it not for the tariff issue, this order would have grabbed the headlines in all newspapers. The Delhi power distribution companies have actually taken the DERC, that is the Delhi electricity regulator, to the Supreme Court, asking for the recovery of their past dues amounting to 27,200 crore rupees. These past dues in jargon are called regulatory assets. The Supreme Court, in response last week, gave a broad order to all the state electricity regulators as follows. First, it said that the tariff decided by the SERCs shall reflect the actual cost of power. Second, the accumulated dues or the regulatory assets should ideally not exceed 3% of the annual revenue requirement of the discoms. Third, these regulatory assets or past dues must be liquidated in 3 years, either by raising tariffs or getting the state governments to pay. The current backlog of past dues have to be paid back in 4 years. That's the telling point of the order. It has more. Joining us now are two former power secretaries, Mr. Alok Kumar and Mr. Pradeep Kumar Pujari. Mr. Pujari has also been the Central Electricity Regulator Commission's chairman. I'm also joined by Nikhil Nigania, the director and senior analyst at Bernstein. Gentlemen, thank you very much indeed for your time. Mr. Pradeep Kumar, if I may start with you, sir, since you have, worn both hats as power secretary and as chairman of the CERC, do you think this moves the needle a bit? There have been several national tariff policies which have told the SERCs to do exactly this, liquidate the past dues in 3 years, 7 years, whatever. Nothing has moved them. Will the Supreme Court order move the needle, at least for Delhi?
Thank you. What Supreme Court has said is already there in the various statutes. The 3% limit, liquidation of the regulatory assets, and when regulatory assets are to be created, they are supposed to be created in under exceptional circumstances. Now, the issue is that not only the statute, but also the various, I'll not call it direction, but various letters that has been issued from the ministry also had asked the regulator to take necessary steps. Unfortunately, when the regulatory assets are created at the same time, the regulator should have included a roadmap within the time frame during which these regulatory assets are supposed to be liquidated. So unfortunately, this has not happened. So I'm really happy about this direction that came from the Supreme Court. And I'm sure that the various regulators, state regulators who are having or have to take necessary action will now take action to liquidate these regulatory assets within the time that has been stipulated by the regulator. The rule and the policy says that the old regulatory or the legacy regulatory assets are supposed to be liquidated within 7 years. However, the Supreme Court has now put a new timeline of 4 years. So they need to be regulated. I'm sure that all the regulators will comply with this direction.
Oh, you feel so? Let me get first thoughts from Mr. Alok Kumar. Sir, it is a large number. I mean, DERC itself has to pay 27,000 crores in terms of legacy assets. Their annual amount is much smaller. It's like 20,000 crores or thereabouts. How are they going to clear this backlog? And it is to all SERCs. So if you go to a state like Tamil Nadu, which is, a huge offender, their accumulated losses or accumulated dues, are 89,000 crores. And in any given year, their annual revenue amount is only 91,000 crores. I mean, this doesn't look even feasible. What's your sense?
Thank you for having me on this show. I will add what Mr. Pujari has said. The Supreme Court has very clearly said it's a regulatory failure. And the regulators are prepared to work under dictation. So that is the sorry state of affairs. But there are some silver lining. If you see the new scheme, the Government of India has floated the RDSS. One of the pre-qualification which participants have to meet every year is the no new regulatory asset has been created and past has been liquidated. If you read the order carefully, they accept Madhya Pradesh, Rajasthan, and Tamil Nadu. This is not a very widespread problem in the country. There's some states where the regulatory failure has been very prominent.
Yeah.
But I'm happy to see, if you leave the case of Delhi for a moment, the 4 states which have given their affidavit, they said that we have not created any significant regulatory assets post 2020. So that means this carrot and stick approach by government of India is working, number one. Number two, DRC also wrote a letter to the government of Delhi saying that they should take it up, that private sector discoms should be able to participate in government of India schemes. What happens? This has been my view.
Yeah.
Normally, the government of India has been excluding the private sector discoms from schemes like RDSS and even other. That is not done because the consumers in those companies, they face tariff hike because grant is not given. So there is also a administrative view which needs to be changed, that under the regulatory oversight, the private discoms should also be made fully eligible for participating in Government of India schemes. Third, I'll say there has been a lot of debate why Ministry Power has come and made rules. Now, I'm very happy that most of the rules which were made when I was in the ministry, now Supreme Court has welcomed. He says, endorsed them. They said there is nothing can be more clearer than tariff policy.
Yes.
So now the issue is that we need the stick from APTEL and Supreme Court, and we need the carrot from Government of India to see that these things doesn't happen. Past dues are huge, and I personally feel like Tamil Nadu has been giving a lot of support to the discoms from their budget. I think part of it has to come from budget. All of it can't be passed to tariff, and some parts should come from the tariff rise. Most important is going forward, the DRC has to give up this approach of giving only 8% of DRS for recovery of capital as well as interest, whereas carrying cost is also more than 8%.
Yes.
So if DRC should correct at least the future stance,
so what is this DRS?
Past can be addressed.
What is DRS?
DRS is called the deficit recovery surcharge, which DRC has been allowing at 8%. It's a laughable. Carrying cost is more than 8%, and you expect to recover everything 8%. That's all I have to say.
Fair point, sir. So let's get a market angle from this. Nikhil, as both the former power secretaries are saying, when the word comes from the Supreme Court, it has a much larger, force of law than a national tariff policy. Policy is a guidance. A Supreme Court judgment is law. So do you think we are going to see, more money flow through? If not all the 2.3 trillion rupees of past dues, will something flow through to the power sector?
Yeah, so absolutely. I think, as Mr. Alok Kumar said, it's a carrot and stick approach, the stick being the Supreme Court and the APTEL, and the carrot being schemes like RDSS by the central government. So definitely a big positive step in the right direction for the broader power sector. In terms of flowing through, if it does, it doesn't impact the P&L of these distribution companies. It impacts the cash flow, which itself is a big benefit. The most immediate beneficiaries would be power distribution companies in Delhi, assuming that's where the case was regarding. And the 3 there are, one is Tata Power, Delhi Distribution. The other 2 are owned by Reliance Infrastructure. We don't cover these names, but they are the ones who stand to gain the most. And beyond that, if we expand it to other parts of the country, then CSC is another one, which has regulatory assets, although not all of it might be approved. And so those are the large ones I would say were immediate